Hello, my name is Lachlan St. Clair and welcome you to the August edition of CSP Smart Money. I thought I'd better start off by picking up from where I ended off and just quickly mention our trip to Broome and the Kimberleys. I went up there for a month with the family. We flew into Broome and spent a month out along the Gibb River Road and Equestro Station and the gorges through that system, and then up to a place called Cape Leveque at Broome. And I must say it was the most fantastic family holiday we've ever done. It's a big adventure. It wasn't a holiday in the sense of sort of sitting around beside a swimming pool, but we saw some amazing parts of Australia and some extraordinary sights. The kids were hiking through underwater caves with freshwater crocodiles in them and all that sort of stuff. So we had an absolute ball, and I really encourage anybody that hasn't had the opportunity to see that part of the world to really try to get out there. If for no other reason, the weather is just spectacular. We didn't see a cloud from when we left Sydney to when we got back. Every day was 32 degrees and 15% humidity. So just a beautiful part of Australia. So couldn't recommend it enough for anybody who's sort of considering getting out there. Anyway, on to business. I must say I came back from the holiday and all of a sudden the share market was through the roof and the bond market was through the roof. So a few things have changed and changed fairly significantly. So this will be a slightly longer Smart Money than the previous one, but we really do have a little bit to talk about today. Firstly, on the domestic side, so on the Australian side, there are some really early signs of a bit of economic improvement. In particular, the housing market does appear to have found a floor at this stage, touch wood. The Sydney property market, certainly all the data that's coming through, looking like it's starting to tick back up again, and a lot more action at auction and clearance rates and all the rest of it. And I think that's really been driven by some stimulus that's come into the economy that is perhaps starting to bite, which would be really good. The Reserve Bank has obviously cut interest rates, more on that later on. Tax rebates, so the coalition win, obviously they got back in. That's led to a spike in business confidence, and their tax rebates are starting to flow through for people who are doing their tax returns early, and that's putting money in people's hands, and that obviously gets spent in the economy. And finally, the Aussie dollar is obviously under a fair bit of pressure at the moment. We're down to 67.55 US cents, which is the lowest it's been since the GFC. And that, although it makes the price of imported goods more expensive, does lead to an improvement in the competitive position of Australian companies who are exporting. That tends to be good for the economy over the longer term. So inflation is still very low. Unemployment has still crept up. That data is yet to turn around. But we're just seeing some very early signs that are potentially positive, although it's certainly too early to sort of call the bottom and say that things are going to be rosy going forward. And in particular, unfortunately, that's the end of the good news. I think in particular, the global environment's probably deteriorated somewhat. The global PMI data, so the Purchasing Manufacturers Index, they're all starting to roll down, as anyone who's had a review with me in the last little while would know. And that's a really good forward-looking data that measures the expansion or contraction of the manufacturing sectors in an economy. And almost all over the world, all those manufacturing sectors look like they're starting to slow down. So that's obviously not a good sign. But I guess the bigger issue and the big game in town, clearly is the US and China and the trade war situation. And something changed significantly a week or two back. Up until that point, all the tariffs that Trump had put on Chinese goods were really industrial goods. So they were goods that US companies bought that were then sort of used in their manufacturing process. So it wasn't sort of necessarily directly passed on to the consumer. However, that changed 2 weeks back, and the latest set of tariffs that Trump is proposing is on directly onto consumer goods. So things like iPhones and iPads and sneakers and sports apparel, etc. All those things are going to increase by 10%. And I think this is where Trump is actually quite smart in his communication. I think if you took a straw poll of the American people, most people seem to think that China's the one that pays the tariffs. And it's actually not. It's the American consumer pays the tariffs. So there's a tax that's put on Chinese products, but the people pay for it. And where I think that's going to get interesting is that if you move that tax out of industrial goods that perhaps can be absorbed by the companies and put it directly into the distribution of consumer goods, you're going to get much more of that price transfer into the American economy, which is basically like fiscal tightening. At the end of the day, you're putting a tax on everything. And so all other things being equal, that should be negative on the US economy, and that's why you're starting to hear comments around recession fears in the United States. So this is a pretty significant issue, actually. China's response to that was not only did they put more tariffs on US goods, they said they weren't going to buy a whole bunch of primary production products from the United States, but they also allowed the yuan, their currency, to devalue. So if someone puts a tax on your goods, but you devalue your yuan, your currency, then you bring the price of that good down to sort of offset that tax component. So it's a pretty significant shot in the trade war, and it's kind of hard to see how this is going to resolve itself, to be honest with you, in the short term. Trump's really digging his heels in, and so is Xi Jinping. And the problem for Australia is you've got our biggest trading partner having a really significant fight with our biggest military alliance, and we're caught in the middle. So Australia's going to face some really difficult challenges, I think, over the next 5 to 10 years politically, as much as anything else economically. And I guess the problem there at the end of the day is no matter what happens in Australia, China's slowing down. If America slows down as well, whatever we do here is going to get swamped, obviously, by the global impact of those two major economies starting to slow down. So some pretty significant concerns there, and certainly some pretty significant risk to the downside. The other thing that has changed significantly from an investment market perspective is that the long-term expectations of interest rates globally have really shifted, taken a big step down. Not only has the Australian Reserve Bank of Australia reduced their interest rates, but the US Federal Reserve has reduced rates. And most major economies, or reserve banks in most major economies around the world, are moving away from quantitative tightening back towards quantitative easing, I should say. And that's led to a significant reduction in long-term interest rates expectations. I was told the other day that Germany issued a 30-year bond at negative yield. Now, to just explain quickly what that means, if Germany issues a bond, so they issue a bond at 30 years' time, if you hold that bond in 30 years' time, it's worth, for example, 100,000 euro. The question becomes, what do you pay for it today? Negative yield means you pay 101,000 euros for something that's going to be worth $100,000 in 30 years' time, which is a bit of a mind-boggling thing to try to get your head around. But the reason that has been done is that the market expects Germany to be in an deflationary environment for 30 years. So $100,000 in 30 years' time will actually be worth more than $101,000 today, which is quite a frightening thought, actually. In addition to that, from a short-term perspective, what that's led to is a significant rally in both the bond market and the share market. So both of those markets have rallied. As many people say, only one of them can be right. The share market has given up a significant amount of that rally in July in the first 2 weeks of August, with the concerns around the consequences of the trade war. Most people I speak to think the bond market's probably right. The US equity market in particular looks overvalued, particularly by historical standards. So we took a more conservative position with our portfolios about 12 months ago. We're certainly not seeing anything that would sort of indicate that we should change that conviction at all at this point in time. So, really fairly concerned about the short and medium term outlook. And just as a final note, I just had a quick look at the TD rates. And in terms of interest rate expectations in Australia, NAB, Commonwealth Bank and ANZ will pay you a higher rate on a term deposit for 3 months than they'll pay you for 3 years. So that indicates that they all expect that interest rates are going to continue to come off as well, which is going to make it harder for people in cash and TDs to earn, to earn a reasonable income. So I suppose that's it for this stage of smart money. I guess in summary, the risks have gone up, really driven by China and the United States. Domestically here, we look okay. The only other comment I wanted to make, it'd be good domestically if our politicians could get past the word surplus. Now is not the right time to be running a surplus. Now is when you run a deficit to stimulate your economy. You run a surplus when times are good. So it'd be nice if we could get some leadership out of our politicians and explain that to the Australian people. But I guess on balance over the next 12 to 18 months, we probably see a little bit more downside risk than we see upside risk. So again, I mentioned this in the last smart money, but patience is the catch cry. With most portfolios who've got an increased defensive position, now is not the time, I should say, to be trying to chase some of those returns you've seen over the last month or two. We do think there's some material risk to the downside. Anyway, that's it from us. Of course, if you'd like to speak to us before your next review, you're always welcome to give us a buzz. Otherwise, we'll look forward to talking with you all soon. Thank you very much.